What's going on, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Album, and today with me, I have Daria Davydenko, who is our sales and operations lead for Roofstock One. And she's going to be talking to us about the history of public and private REITs, really what they are, and who might be a good fit for investing in them. So let's get into it. Daria, what's going on? Welcome back to the podcast. Great to have you back.
Hey, Michael. Good to see you again. Thank you for having me.
No, my pleasure. My pleasure. Great to see you again. So today we're talking about a really cool offering that Roofstock has, Roofstock One. Can you give us a really quick insight into what that is? And then I would love if you could help walk us through kind of the history of REITs and this product and how it came to be.
Yeah, sure. So Roofstock One is a relatively new offering that we have as part of all of the different product suites that we have on roofstock.com. Roofstock One is structured as a private REIT. So one of the benefits of kind of investing in Roofstock One is if you invest in real rental properties, you have the benefit of knowing exactly what you own. While it is a nice benefit, generally it's not available to with a more passive real estate investments like REIT, public or private. However, we made Roofstock One different. Even though it is structured as a private REIT, it is a fully transparent and customizable. So you know exactly what you own by buying a share of Roofstock One. So it is the first of its kind single-family rental REIT that's transparent and somewhat customizable to investors.
Awesome. All right. Well, we're definitely going to dig more into that here in a little bit, but I would love if you could give us, again, a kind of a background, like what is a REIT? How did we get here? Public versus private? Bring us up to speed.
Yeah. So actually, REITs have a very interesting history that I don't think a lot of people realize how the first, private equity firms have emerged and then how kind of REIT structure was created. So back in the 1980s, investors were mainly individuals and they were kind of using real estate to kind of harvest losses and shelter profits. So that was kind of the main reason why people were investing in real estate. And also in the 80s, there was something that was called SNL. That they were created by the Federal Home Loan Bank Act in 1932. They were like savings and loan banks that basically had some caps on interest rates on deposits and loans. But they were able to basically lend money to those individuals so they can buy real estate. Now, obviously, in the 80s, we all know that there was a recession. And so because of the restrictions that were placed on these SNL banks, because they had some caps on interest rates on deposit and loans, it greatly limited their ability to compete with other lenders as the economy slowed and inflation took hold. And so, for instance, as savers piled money into the newly created money market funds that were yielding like a much higher interest rates, like SNL just could not compete with those traditional banks due to their kind of lending restrictions. And so when you add the recession to it, what happened is because the recession was sparked by the high interest rates that were set by the Fed in an effort to end a double-digit inflation, which is kind of what we are kind of seeing right nowadays. So SNL were left with little more than, kind of like a dwindling portfolio of low interest rate mortgage loans. And so obviously their revenue stream, were severely tightened. And so in the 1986, Reagan changed the law, and then the syndication was, basically was no longer working, and there was no longer like the tax loss harvesting that was allowed in real estate. That kind of actually caused the real estate values to crater because a lot of people did not see any value of investing, or holding real estate anymore. And so that actually caused SNL crisis. And so I think a lot of people don't realize, but during the SNL crisis, there were like 8,000 banks that have failed. So because of this kind of crisis that happened, this was like the largest crisis, since the largest collapse of U.S. financial institutions since the Great Depression. And so like that kind of happened in the 1986. And so what happened, right? So once the S&L kind of crisis happened, the government had to step in. So what they found that there was a lot of highly levered foreclosed S&L that owned a lot of real estate. And so government inadvertently owned those banks. And so they end up owning hundreds and thousands of properties. What happened next is they have created something that's called a Resolution Trust Corporation that basically became a property manager. So their sole purpose was to own and dispose of those distressed assets. So Resolution Trust Corporation, or short RTC, was a temporary federal agency. So basically from the 89 to the 95, they largely were trying to kind of resolve this S&L crisis that happened in the 1980s. They were basically like trying to do some property management, cleaning up what was left behind. And another, I guess, purpose for creation, the RTC, was to dispose of these assets. Now, the government wants to sell a lot of assets. And so they need to have, it's going to be highly inefficient for them to find like a single buyer and buy like who can just buy like a single property. So what they had to do is they had to figure out how to find a pooled vehicle that can just come in and buy this pooled kind of assets. And so that's when the first private equity firms were created, who kind of came in. They were able to kind of pool financing, and then kind of buy like large amounts of this kind of real estate that was left behind after the S&L crisis. So that's where kind of the real estate, or, kind of private equity investing was created. That's kind of the history of it. Now, the real estate investment trust were a way for individual investors or even institutional investors to get exposure to real estate without kind of having to go through like active management of the underlying real estate. So real estate investment trust was a way for you to get exposure to, real estate asset class, but you don't have to kind of forego the whole kind of financing, closing, property management aspect of it, while still enjoying the benefits of getting the dividend distributions from the rental income, the appreciation of the properties, etc. And in addition to that, kind of REITs were created to encourage investors to get into the real estate market and also get some kind of tax benefits from it. Now, I know I spoke a lot, so I just want to make sure there's any questions that I can answer for you, Michael.
This is super interesting. I mean, one thing that terrifies me is this idea of governmental property management. That just would have been an absolute nightmare, because we all know how that probably worked out. But I think that makes a ton of sense. And so these private equity firms were created to buy all of the hundreds of thousands of distressed assets that the government ended up owning because of the collapse and the financial crisis. But so maybe help me understand what a REIT is. Like, is a REIT a share of the private equity company that then owns these properties? Is that how that works?
Yeah, so REIT is basically like a pooled vehicle. You can imagine that, let's say, like just as a simple example, let's say you, Michael, you own kind of 10 different properties, and you would like to allow other, investors to kind of participate in ownership of those properties. You can package them basically into a REIT. Of course, this is more complex than kind of what I'm describing, but in the simple terms, you can package it into the REIT and sell basically shares of this REIT to other investors who can get economic benefits of kind of owning 10 of those properties. REIT, like many companies, they distribute earnings to investors in the form of dividends. Unlike many companies, however, REIT incomes are not taxed at the corporate level. So kind of that means that REITs are actually, they avoid the double taxation of corporate tax and personal income tax. So instead, REITs are sheltered from the corporate taxes, so their investors are only taxed once. And this is a major reason why investors value REITs over, other dividend-paying kind of structures out there. Another benefit of REITs, I guess, that they were created is that they're widely used because they're highly favorable tax advantages. So REITs are required to distribute 90% of their earnings to investors. And so that kind of allows them to avoid the double taxation that I mentioned previously. And so this benefit kind of trickles down to all the underlying investors. they're not being double taxed and they can receive the maximum amount of capital from REIT. I guess another advantage, I mean, we all know that investing in real estate, one of the biggest advantages is the depreciation. So depreciation can be passed through to individual investors, even in a REIT structure. Basically, because you get to offset your income with a depreciation kind of tax deduction. Let's say you might be earning $10 per share, but you only will be paying like $7, as an example, paying taxes on the $7 of those earnings.
Okay.
And in addition to that, if you're kind of holding your shares for longer than a year, you will be paying the long-term capital gain taxes, which is kind of much lower than your ordinary income tax. There was another kind of, I guess, good question that you raised, Michael, about what is the difference between private and public REITs. The main difference is private REITs are less liquid, compared to public REITs. Public REITs are the ones that are being traded on the public stock exchange. And so you're basically they're just like stocks. You can buy them and you can sell them, and you will also be getting the dividends. While private REITs, they're not being traded on the public stock market. And so hence they're being thought after as like a less liquid option for you to own real estate. But at the same time, they're less volatile, obviously, because they're not subject to all of the changes that are happening in the public markets. So it's just there is just some major differences, right? The liquidity, but because you're foregoing the liquidity, you're obviously getting less of like a volatility in the stock price of your of the shares of the REIT. So that's the major difference between public and private REITs.
Okay. Yeah, that makes a ton of sense. Thanks for walking me through that. I guess the question that gets begged next is, Roofstock has been a marketplace for transacting on single family homes for years now. Why is this product coming about? Who is it designed to serve, and who might it not be a good fit for?
No, that's an excellent question. I think what we have found is We've been speaking with investors who come to the roofstock.com website and who really enjoy owning real estate and single family rental properties in particular. One of the feedbacks we have been receiving from investors is that they are, some of them, obviously, if you want to buy properties outright, you are getting, there's like a large deposit, I guess, that you have to put to buy a property. There's a financing. There is like a very long process of closing. Now, Roofstock does a very good job at making sure that we simplify this process for investors. So we try to make it as simple and as friendly as possible. But still, there are multiple steps for you to close on a single property. But obviously, you will be subject to that single asset risk, right? If you are only owning a single property, you will whatever happens with this property, it will greatly affect your cash flow.
Right.
Now, Roofstock One, we have created Roofstock One because investors have been basically asking us, hey, I really enjoy single family rental investing, but I'm still trying to learn the space and understand how it works. I've never owned single family rentals before. And so I'd like to dip my toes into this asset class. And so I think Roofstock One offers this perfect opportunity for somebody to own this exposure to this asset class, single family rentals, while, being completely passive. So meaning you don't need to go through the the whole process of closing on the property, finding the financing, finding the property manager. We do all of that for you. You just buy the share of Roofstock One REIT. You get exposure to this particular asset class, and then get, potentially get quarterly dividends from the rental income. And just learn a little bit about single family rentals, how it works, how you receive the dividends, and get accustomed to owning single family rental asset class. What we have seen is there are, some investors who really enjoy being actively involved in the day-to-day of managing properties, because you get this owner experience that some people really like. And so for those people, maybe Roofstock One might be a little bit too hands-off. And so they might prefer to do the direct ownership of the property. But there are also a certain subset of individuals who just don't have the time to like investigate and spend time with property management companies and figure out like, if they should increase the rent or drop the rent, just to find tenants for the house, or should they change the roof or change the water heater in a property, or wait for another month or two.
Yeah.
So kind of
all
of
operational
those
stuff.
all the operational stuff, like all of this kind of micro decisions that you kind of don't realize, but they do pile up, and they do take a little bit of your time. So some of those individuals are like, look, I just want an exposure to this particular asset class. I want it to be passive. I really enjoy it. I think, I believe in single family rental kind of asset class in particular. And so, this is like a perfect way for me to get a passive exposure while still kind of feeling like I'm owning some, underlying properties. And we try to kind of make it as transparent as possible to investors, so they actually can see, what properties are inside, Roofstock One REIT, so they can understand, what homes kind of they're tracking the economic performance of. And so they're still kind of getting the feeling of like, okay, with this share, I potentially can own 10 to 20 to, how many properties they would like, still kind of feel like they're owning those properties, but, they don't have to spend as much time on the operational day-to-day stuff. So yeah, that's kind of the major reason why we have created Roofstock One, is just to serve certain subset of our investors that we have seen come to roofstock.com website. And, obviously, there is absolutely still a lot of kind of benefit of owning the properties outright. But there is also like, there's just a time kind of aspect that's involved in it as well.
Yeah, that makes a ton of sense. And you said something about, for those people that are still learning, want to dip their toes into the water, Roofstock One might be a good fit. But if I'm thinking about like a traditional REIT, I can go buy it on the stock market. I buy a share of it. I don't hear from anyone. I don't know what's going on in the data. Like, I have zero insight into that.
Yes.
Is that different with Roofstock One? Like, can someone truly expect to learn a little bit about what it's like to own single family rentals with Roofstock One? Or is it going to be just as hands off and passive and kind of at a distance like a traditional REIT would be?
I'd say it's somewhere in the middle. So, it is just as hands-off and passive. But I guess the major benefit is in public REITs, I guess it's a little bit more of like a pooled vehicle. So just by buying a share of like a public REIT, let's say, for example, that there are like 1,000 properties that a public REIT owns. Now, they can be in different, like various markets, right? So they could be across many different states in the United States. And so you kind of get exposure to all of those kind of little, properties a little bit. So Roofstock One allows you to be a little bit more targeted if you wish to do so. We have something that's kind of called like a tracking stock, which is like a mini portfolio of subset of properties. So let's say if you're interested in a certain region in the US, just as an example, let's say Georgia, because you believe in this region, or maybe you have invested in this region before, you can get exposure only to the properties in Georgia instead of kind of getting the, exposure to all of the properties inside the Roofstock One. But at the same time, if you don't have any convictions and you just kind of enjoy single family rental kind of asset class, and you just want to have diversification, then you can also just kind of do that, and you can just buy exposure to all of the properties inside the Roofstock One REIT. So we kind of just provide like an ultimate flexibility of investors coming in and kind of creating their own journey, almost like a custom REIT. Create your own custom REIT.
The Subway sandwich of REITs.
Exactly. Yeah, it's like a Subway sandwich. You're correct. Yeah, it's just, you choose whatever you want, like, and you can even choose your own sauce with it.
Except we use real fish and real meat in our Subway sandwich that is Roofstock One. I don't know if the Subway is the best analogy, but people get the point.
Yeah, I like it. We're the, like, I guess with public REITs, you're just kind of getting the, whatever the pre-packaged Subway sandwich that, is not customizable, and you can't even choose your sauce. Yeah. So that's kind of how I would think about it. I think the benefit of it is like, look, you can still kind of see what are the properties, underlying properties inside the, like those mini portfolios, for example, which is definitely something that you won't get with like a traditional public REITs. I feel like that they're kind of more giving you like, hey, this is our general structure or general investment objective. This is what we are doing. This is like, let's say 30% of our portfolio is in Georgia, like X percentage is in some other state, which is also great for those people who don't really have much conviction and maybe they just want to get a general kind of diversified exposure. But you can also have to just be mindful of this kind of this still difference. There is still like this difference that exists between private and public REITs where, public REITs are still subject to the same market volatility as any other stock would be. I wouldn't say that there is like one right or wrong way. It's just kind of, it's all about diversification and what fits your investment goals and investment needs, what makes sense for you and for your investment portfolio. And we are just kind of offering a way for real estate investors to create their custom REITs if they want to, get exposure to the whole asset class if they wish to do so. They can also mix and match. They can invest a little bit into public REITs, a little bit into private REITs. And again, it's always, diversification has always been a good way for you to kind of diversify your risk. So,
yeah. Okay, I dig it. Well, Daria, I have a question that's maybe on everybody's mind who's listening.
Yeah.
You talked about the hurdles and barriers to entry of investing directly, and that's usually coming in the form of down payment and having to go to financing, and there's steps involved. How much does investing in Roofstock One cost? Is there a minimum investment? Is there a maximum investment? Like, walk us through what that looks like.
Yeah, so we actually kind of tried to bring it down to minimum investment is $5,000. So there is like a limitation that you do have to be an accredited investor.
Okay.
An accredited investor is something that's basically set up by SEC. That's kind of their rules and regulations that in order for you to be invested in private REIT, you kind of have to be an accredited investor. And I think it's kind of basically done for the benefit of the investors themselves. Since it is a limited liquidity, you do want to make sure you have enough liquid cash that kind of set aside, that you have access to, because you will, if you're invested into like any private vehicle, private REIT or anything else, usually, you will not be able to like withdraw those money for like 5 years or so. And so kind of, I think that accredited investor is just kind of really done to make sure that investors understand that this particular funds will not be able to access it, and they have enough liquidity on hands to, meet some sort of like liquidity needs that they have during their like day-to-day life. An accredited investor, someone who is an accredited investor. I guess accredited investor is someone who has a net worth of $1 million, and that can include their real estate investment portfolio or retirement portfolios or, bank assets, kind of you name it. It can't include their private primary residence, but if they have secondary homes, if they can only count equity basically on those properties. So if they have like a mortgage on a secondary home, they will have to figure out like how much of equity they have, and they can count it towards their net worth. Another way to understand if you are an accredited investor is if you are making over $200,000 per year, and you've made over $200,000 per year in the past 2 years. Or you and your spouse or partner are making over $300,000 together this year and in the past 2 years. So those are kind of some of the limitations that been set, and we just kind of follow those limitations. But as long as you are kind of an accredited investor, you can put $5,000 into like a Roofstock One REIT, and this $5,000 can be invested across all of our offerings. So we are not limiting. You can only put $5,000 into like a single kind of mini portfolio or a tracking stock, what we call. You can, put $1,000 or $100 into tracking stock and the rest into like a bigger fund, or, vice versa. So you can customize this $5,000 as much as you would like. So yeah, that's kind of the limit. Yeah.
Great. Okay. And I would imagine that other private REITs, and for sure public REITs that have been around for a while, have a track record, the history of performance. Does Roofstock One have that yet, or is it too new? Like, how has it been performing to date?
Yeah, we do have a track record on Roofstock. Roofstock One, we launched Roofstock One in November last year, so we are a little bit close to like a year of existence. So we have been distributing dividends, and the dividend yields that we have distributed for the historical or like our past offerings, they are listed on our website. They can be accessed via the investor reports. And we also do have appreciation of the assets that has happened since we acquired them back in, let's say, November. So we just recently started to calculate something that's called NAV, which is net asset value of our investments. And that's in general how private REITs figure out what is the value of their shares. So unlike public REITs, where the share price is being determined by the kind of just the normal forces of the markets, private REITs, because they're private, they had to kind of figure out a way to value the assets, the underlying assets that they have. And so the net asset value is kind of the common term, or NAV is kind of common term that they use to figure out what is the share price of their REIT.
Okay.
And that's what Roofstock One does as well. So we are just like any other private REIT. We calculate NAV, we publish it, and then kind of investors are able to track estimated value of their shares. Now, the reason I say it's estimated is because obviously, until we sell the assets, we wouldn't know the exact value of the underlying assets. We can only kind of do like an estimation of where we think it is right now. But it is, a good proxy, I guess, for an investor to think, hey, this is like my estimated value. But, until you kind of actually sell the assets, just kind of the nature of real estate market in general, that it's very illiquid, and you wouldn't know the value of the asset until you actually like list it for sale and you start getting some buyers who are interested, giving you offers, etc. So very similar, in REITs, because we own underlying assets. We are kind of subject to the same market forces as anyone else who owns real estate. But, net asset value is a good measure for someone to use to determine what is the estimated value of their shares.
Okay. Super informative, from the history to the product offering and why it makes sense. This is awesome. If people want to learn more about private REITs, chat with you, learn about Roofstock One, where's the best place for them to do that?
Yeah, we can be found on the roofstock.com website, or someone can just type in www.roofstock.com/ONE1. That's our website. Feel free to give us a call. There's a button that you can click on and request a phone call, and we have very friendly people to chat, and we're always happy to talk about real estate, private REITs, single-family rentals investing. We love investors ask us questions, and we love talking to them on various subjects. So yeah, feel free to check out our websites, stop by, ask questions, and we are always happy to chat.
Amazing. Well, thanks again, and definitely looking forward to seeing where Roofstock One goes from here. Talk soon.
Thank you, Michael. Thank you for having me today.
You got it. Take care. Okay, everyone. That was our episode. A big thank you to Daria for coming on. Really interesting stuff with the product offering as well as the history of REITs themselves. So go check out the website at roofstock.com/one. As always, if you enjoyed the episode, definitely love hearing from you all. Ratings and reviews are super appreciated, and we look forward to seeing you on the next one. Happy investing.